Morning everybody, thank you for joining our webinar today, Self-Assessment Tax for Landlords. Today's webinar is being presented by the team here at GoSimpleTax. You may know my name's Leanne, and Aidan, who will join us shortly, will be your main host. I just want to take this opportunity again to thank the IAB for allowing us to bring this webinar to you all today. Before we start, there's just a little housekeeping I need to run through with you. The webinar is being recorded and all information provided is correct at the time of recording. Today's date being the 6th of July 2023. In the top left of your screen you'll see a Q&A section. Please feel free to ask questions as we go along. Aidan will answer as many of these as he can at the end of the presentation. Okay, I think that's everything covered, so at this time I'm going to hand you over to Aidan, who'll start today's presentation. Aidan, if you're ready.
Thanks, Leanne. Just checking, can you hear me yet?
Yeah, we can hear you fine, thank you.
Good. Okie dokie. Hi everyone, thanks for joining today. We're going to be looking at self-assessment tax for landlords. As usual, we'll start with a poll. Oh no, we won't. We'll go through content first and then we'll go do a poll. So what we're looking at today. So pretty much what was on the webinar invite when you signed up. So we're looking at expenses for landlords, basically capital versus revenue. What are they? What can be claimed, then move on to what can't be claimed. There was a mention of EPC rating regulations, and basically what are those, what will they be in the future, and also can these expenses be claimed. And then we'll have a little chat about tax, which should merge with the Q&A. If anyone wants to ask questions throughout, then make sure you do. So we've got something to discuss later on towards the end of the webinar. So there we go. Poll number 1. If Leanne can set that up for us on your screen now, you should be able to vote. How do you currently prepare and submit your client self-assessments? So the options are HMRC portal, digital software, GoSimpleTax, Excel, and or none. So let me just adjust my screen. Let's have a look. So we've got a 53% voting. So if we can try and get them votes up, more people to vote. There we go. A couple more votes and I will publish the results. Good, good, good. Perfect. Okay, so we look to have oh no, people still voting. There we go. Okay, so I'll just publish the results now. We've got roughly 70% of people who are on the webinar to vote, so that's all good. So just having a look. And we've got 27% using HMRC, 39% using digital software, 3% GoSimpleTax, 27% don't offer this service, and then 3% alternate method. Great, great, great. So let's just hide those and crack on with the webinar. Okay, so capital versus revenue expenditure. I would expect most people to know this on the basis that it's not changed for a while. HMRC have always taken this stance, or as long as I've been doing it anyway, and I've been within the tax industry for 11 years. So we'll just push through. So what is capital in nature? So basically capital in nature would relate to improvements, basically costs that have been incurred that don't directly relate to the trade, and usually relate to the increase in the property's value. Not always, but most of the time. So that's pretty much what's capital in nature. And then in comparison to what is revenue in nature, there'll be a famous phrase which I'm sure you've all probably heard before coming up. So basically, what is revenue expenditure? It's general expenditure or costs incurred for the purpose of the trade being the rental property business, being a trade. And it's basically to make sure that the business can run smoothly with no duality of purpose. So that usually is covered by the wholly and exclusively rule, making sure that the expenses incurred wholly and exclusively for the purpose of the business and not for other means, which I'll come to when we look at the allowable revenue on the next slide. So they're brief and broad definitions. So allowable revenue expenditure. So what are the actual revenue expenses categories? So if you're completing a tax return, what are you looking for? So these are the main categories that you'll see on a tax return. So repairs and maintenance. What is repair and maintenance? Well, it's basically anything that already exists that A, needs repairing, or B, needs to be maintained to keep a level of reason for having it. So basically repairs would be if a door gets broken, kitchen utensils get broken and they can be repaired, cupboard doors, handles, anything like that that gets broken and can be repaired, they would fall within the repairs. Maintenance are, as I said, basically keeping with the upkeep of items in the house. So maintenance usually would follow on if you're, let's say you've got an apartment block or a flat block, and there would be maintenance charges throughout the year to basically keep the upkeep of the building. That would be seen as maintenance and would be allowable against rental income. Legal and professional, if you have an accountant, or obviously you guys are bookkeepers / accountants yourselves, so you would usually put your fees to your client in that section. Rents, rates and insurance, including council tax. So rents, rates and insurance, rents such as ground rents, rates, electric, water, gas, insurances for property and contents, or anything else that you may need. And then that also includes council tax. So during the year, if your client or yourself have a vacant property and you end up paying the, let's say, gas, electric, water and council tax during the vacant period, that would be an allowable expense. Likewise, if you want to be, or your client wants to be super generous and pay those expenses on behalf of the tenant, then those would also be allowable against rental income. Services, I would usually stick in there if you've got estate agents that have that. You can either stick that in legal and professional or services. It depends on what you want to include it in. But also you've got some things such as gardener, window cleaner, those where people come round periodically and basically maintain the premises in terms of visuals. Those can be allowable. Travel is one that's usually forgotten. Make sure that your clients know that if they go and inspect the property, then the travel can be included. Usually you would use the mileage allowance for that, 10,000 first 10,000 miles at 45 pence, and then 25 pence thereafter. But for example, with travel, if you have non-resident landlords and they fly over to come and view the property, if during that visit they also go and see family, go and view a house that they want to buy separate, then technically the travel would not be allowed. You could contact HMRC and ask whether a percentage would be allowable, but usually it's the wholly and exclusively rule. The travel would have to wholly and exclusively be for the purpose of the property business. So an inspection 4 times a year, twice a year, once a year would qualify for that wholly and exclusive rule, but as long as it's not also a holiday, for example, if you're traveling across the country. Other admin costs, if you use your mobile phone, or your client uses a mobile phone in regards to arranging visits, speaking with estate agents, and etc., then they could claim a percentage of the cost of the mobile phone. And that in general is what expenses would be allowable against profits. I've included finance costs on here. So finance costs are still allowable, however, they're not an allowable expense. They are now restricted as a tax reducer. It's been a fair few years now. I think it's 2017 that it got introduced, or 2018 that it got introduced, whereby mortgage interest was no longer an allowable expense, and it's slowly phased out from 25% not allowable, 50% not allowable, 75% not allowable, into where we're at now as a tax reducer. So along with those finance cost mortgage interests, also the renewal of a mortgage, so getting a new mortgage would be an allowable expense to cost on that, which is another one that people usually do forget. So revenue expenditure as well, we've also got relief for replacing domestic items. So relief for replacing domestic items isn't quite an allowable expense, it's more an allowable relief. So if those that are familiar with the SA 105 page, you'll see that the expenses are in one section, and then underneath you'll have available reliefs, usually capital allowances, and replacing of domestic items or white goods is included in there. So what is replacing domestic items? Well, it was a new allowance recently introduced, which allows for the relief or allowable expenditure of the following groups. For movable furniture, so if you have a sofa, table, bed frame, etc. already in the property and you are replacing it, then you would be allowed to claim the cost of the replacement. Likewise with furnishings, if you've got curtains, rug, carpets, wooden flooring, etc., if those are replaced, bearing in mind like for like, then they would be allowable under the replacement domestic items rule. Household appliances, again, fridge, freezers, washing machines, all those, if they pre-existed and you are replacing them, then you can claim. And then again, kitchenware, utensils, crockery, cutlery, etc. It is worth noting that I mentioned multiple times there, it is replacing domestic items. If this property that your client's just bought or yourself have just bought has none of these things in there, then the initial cost will not be allowable against rental income on the tax return, mainly because it doesn't include the first initial purchase. It is for the replacement of those items. And this basically evens out the field for residential property lets in line with furnished holiday lets, which allow for capital allowances instead of the above. So all the above can be claimed with less restrictions as a FHL in comparison to a residential property. A few years ago, if you were trying to claim for carpets, rugs, curtains, etc., it was a like-for-like rule. And if it wasn't like-for-like, then you wouldn't be able to claim it. Then, whereas now HMRC have kindly introduced this domestic items rule, which isn't actually capped either. So those are the allowable revenue expenditure. Any questions or any unsureties in terms of what you can't claim? If you've got a prime example, then stick it in the questions, and we will come to that a little bit later on.
Just before you do, Aidan, because there is one on a mortgage, I just thought it's more might make more sense to actually answer the question now. Somebody's just asked, so an interest-only mortgage on a property, is that not allowable at all?
So in regards to that, it still follows the same rules for the restriction. So the interest, let's say for example, the interest for the year is £4,000. The actual profit and loss of the rental property would not include that £4,000. The £4,000 would come into the tax calculation, and basically on the tax calculation, then you'd have X amount of taxable profits. The mortgage interest is then offset against taxable profits only, and it's limited to basic rate, which is basically all those higher rate earners that have rental properties are being shortchanged basically for mortgage interest these days in comparison to the previous rules. But yes, so a mortgage interest only mortgage, you would be allowed to claim it as a tax reducer, but only if there's taxable profits. on there. If we aren't sure about what the mortgage interest tax reducer rules are, stick them down in the Q&A and I'll come to them later on. So now we're going to look at allowable capital expenditure. We're not only looking at revenue today, we're looking at a little bit of capital as well. So capital expense categories. What do we usually look? So these are basically costs that can be claimed upon sale. So the main ones here that you would usually include are initial purchase price, so the cost of the property. When you come to sell, the cost of the property can be offset against the proceeds. Incidental costs on purchase, so those would be the usual solicitor fees, any surveys that were done, stamp duty, land tax that was paid, is what would come under incidental cost on purchase. Incidental cost on sale, estate agent fees, solicitor fees, and anything else that you might have incurred on the sale in relation to the property only, that would come under it. And then also during the ownership of the property, any improvement work that's completed, but important note there is that still exists as well. If you were purchased, for example, you had a property for 20 years, in year 10 of owning it, you made a extension that cost £10,000. 10 years later, when you come to sell it and you've still got that extension, that would be an allowable improvement work cost. If, however, you actually on year 10 made that extension, on year 15 you knocked down the extension and created a different extension, then the first extension in year 10 would not be allowable because it no longer exists, and therefore wouldn't be allowed when you come to calculate what the profits are, chargeable profits are on the sale of the property. The year 15 extension would be allowable because it still exists when you come to sell it, but the year 10 one wouldn't. Just a little note there for some people, as that is a little quirky rule which not many people are aware of sometimes. So reliefs are available upon sale. So along with those expenses on the left hand side, let's have a look at the right hand side and see what we have here. So we've got PPR, or principal private residence relief. Basically, that is if you lived in the property as your main home during the ownership, the time that you were or had it as your main residence would not be chargeable to tax. That would be basically exempt. Along with that, the final 9 months of the ownership, regardless of whether you were living there at the time or not, also is included in that PPR claim. So, quick example, we've had a property for 10 years and 9 months, just to make it a little bit easier. I've had the property 10 years and 9 months. 5 years you lived in it, then you moved out and you let it out for the remaining time, the 5 years and 9 months. Through PPR, you owned it and had it as your main home for the first 5 years. So that's 5 years that isn't taxable. And then just as the rule for PPR, you also get the final 9 months automatically. So out of the 10 years and 9 months that it was owned for, the 5 years and 9 months would actually be not taxable or exempt from tax. And there would only be a calculation then of however many months that it was let out for would be then taxable. So 5 years over 10 years and 9 months times by the proceeds would be what the PPR relief it claimed for there. If the final 9 months overlap with your main residence, you don't get additional time. It just obviously would just equate to the total length of ownership. One thing there in regards to that, which has changed recently, is lettings relief. Previously, lettings relief, provided that you had PPR at some point in the past, you could then claim lettings relief. This changed, however, in 2021, where if you previously had a main residence, you then let it out. You moved out, sorry, and then you let it out in full. So the full dwelling was being let. lettings relief no longer became available. Whereas previously you would get both the PPR and lettings relief, which most of the time covered quite a lot of the gain. Whereas now, basically, you would have your main home, and part of the main home would have to be let out whilst you still live there, in order to get lettings relief. So that changed in 2021, and it was again something that shortchanged a lot of landlords that were looking to sell, where they previously had the home as the main residence, and they were letting it out up to the date of sale. So yeah, lettings relief is quite a lot harder to claim these days, on the basis that you need to be living in the property still, and it needs to be renting out part of the home to be able to claim it. And finally, business asset disposal relief, or previously entrepreneurs relief. This relates only to FHLs, or furnished holiday lets. Basically, the property must have been a furnished holiday let that had been trading for 2 years or more, or at least 2 years at the date of sale. This is a nice one these days for the main reason of Airbnbs. If you have a residential property that could may attract people to come and visit there, let's say you live seaside town, or you have the property in a seaside town, let's say, or maybe in the lakes, or somewhere basically where people would want to go and visit, you could stop the residential long-term let 2 years prior to selling. I know a lot of 40%. Oh, sorry, 1 second. Sorry, my speaker went on then. Sorry, the business disposal relief. So you could have a long-term residential property let, and 2 years prior to selling, you could be like, right, okay, I want to get the lower rates of tax here. So rather than paying 18% or 28% on residential properties, I could create that property and add it onto Airbnb, for example, have short-term lets for 2 years, make sure it qualifies as a furnished holiday let, and then when it comes to be sold, it can qualify for business asset disposal relief, which is at 10%. There are quite quirky rules on business asset disposal relief and furnished holiday let businesses. If you've got more than one property, then it is unlikely that you will be able to claim BADR. However, if you have a portfolio of properties, all residential lets long term, let's say 5 properties, if one property at a time for every 2 years, you basically introduced it into FHL rules, you could potentially claim BADR for your clients or yourself and get those at the lower tax rates. That would obviously take some planning, but it is available provided that you meet all the criteria on that. So that's a little tax planning tip if you do have any clients that could do that sort of planning over 2 years at a time per property. Hopefully all the above makes sense. If you've got any questions, again, stick it in chat and we can come to that either now if Leanne interrupts, or later on the Q&A.
No, just to let you know, there isn't any other questions on that. But I just put a comment in the Q&A that other smart speakers are available, not just Amazon speakers.
So yeah, that was that one. Moving on, we've got expenses that you can't claim against income. So looking at these now, there's lots of misconceptions in regards to what can and can't be claimed. But I'll just throw in some common examples of things that are claimed within P&L accounts that shouldn't. And obviously, the first one is mortgage interest. For a residential property these days, mortgage interest is not technically allowable in P&L. It's allowable through as a tax reducer, as I mentioned a little bit earlier. If you've got a commercial property, i.e. you're letting out a shop that isn't residential, the mortgage interest is still allowable. However, for residential properties, it is not. Private use. If you have furnished holiday lets or rental property, and for a certain amount of time you end up visiting or living in that property, then the cost of expenses whilst you're living there are not allowable, and should be adjusted for private use in the year. So if you have a furnished holiday let in the lakes, again, for example, and you go and visit it 6 months out of, it's not 6 months, sorry, 6 weeks out of 52, then you should be technically including all expenses during the year, and then apportioning it 6/52 as private use, and therefore the full claim would not be allowable. Expenses you haven't paid for should be an obvious one, and it should be an obvious one for your clients. But if they aren't, let's say, for example, paying the council tax that is due because the tenant is paying it, then it would not be allowable for themselves. They have to have actually incurred the expense in order to get the tax relief in regards to said expense. In my time, I've seen people try and claim for everything, even though they haven't actually incurred it themselves. I mean, they would have incurred it if the property was vacant, but they hadn't, and for some reason they tried to claim it regardless. Interesting one. So next one, we've got parking tickets. Same for self-employment, this one. If you receive a parking ticket or a speeding ticket when going to travel towards the property to go and inspect it, or you park on double yellows when inspecting the property, then these expenses aren't allowable. Funnily enough, they don't meet the wholly and exclusively rule. You aren't required to receive a parking ticket in order to go and inspect the property. Therefore, it would not be allowable. Again, I've seen multiple people try and claim this and say, I wouldn't have received it if I weren't going to inspect the property. Unfortunately, no, you can't actually claim parking and speeding tickets. The capital repayment of the mortgage. If you have a capital repayment option or your client has a capital repayment option, the actual capital element is not allowable, and it is only the mortgage interest that is allowable as a tax reducer. So make sure that you do distinguish between the capital and interest elements of a mortgage, as they are not allowable in either revenue or capital. And improvements to existing items. So if you are improving certain things, so not covered by like for like, such as carpets, curtains, windows, etc., then you would not be allowed to include that. Likewise, improving the property in general, which would be covered by the final two here. So purchasing new items and materials for new buildings, such as extensions, all those are not allowable against income. As mentioned before, some of them, such as the extension materials, may be allowable against the capital when you come to sell a property, provided it still exists. However, the purchase of new items is not allowable against income, and neither is the materials for new buildings. So that is, there are 8 points, of which I've expanded on each one. If you've got any questions on things that you think are allowable, but might not be, again, stick it in Q&A and we can visit that shortly. So, based off what I've been saying here, if Leanne can kindly get up the second poll, do you think the expenses for improving the EPC rating of a property are allowable? So if you have a property that is, let's say, for example, a G, I think G is the worst rating, I'm not too sure, but let's say it is, and you need to improve it to a E, I think currently, we'll touch on that shortly, but do you think the expenses for improving EPC are allowable? Yes, no, depends, and unsure. So we can get a few votes in there. We're halfway through in terms of people voting who are currently present. If we can get to around that 70% mark again, I will then release the results. Just going to take a breather, bear with me. Okay, it seems to have gone pretty still in terms of votes. Last few seconds, if you do want to vote. Okay. So we do have quite a mix of results here. We've got 25% thinking yes, 30% thinking no. We've got 33% thinking depends and 11% unsure. So I'm not going to tell you yet what I'm going to do, and I'm hoping that we can actually do this, is we'll revisit this back later and see if people want to change their mind after we've seen the next slide. So if I hide those results, come on to here, and what were the changes? So this is aside from tax. I've done a little bit of research online, and this is what I can see in terms of the changes. So this is in regards to law and is not regards to tax. So from April 18, new property lets were required to have a EPC rating of at least E. I believe that from April 23, which is April just gone, that then expanded to all lettings, including existing lettings, should have an EPC rating of a letter E. This basically meant that landlords would be unable to continue letting if their EPC rating was less than E. And also, I believe it is relevant when you come to sell a property. When you come to sell a property, if it doesn't have an EPC rating of E or better, then I believe that you would have to make amendments in order to get the property sold, which I actually wasn't aware of until reading about this. So yeah, that's basically the change from April 23. And then I've noticed that there's a couple of changes coming through in the next couple of years. I've got December 25 from what I've seen online. Correct me if I'm wrong on this one, but a few different websites which were pretty or appeared to be pretty up to date said that from December 25, new tenancies must have an EPC rating of C. So that's an improvement of obviously 2 letters. And then from 2028, all tenancies must have an EPC rating of C or above. So we can see here that the government is pledging to be obviously more economical, and that is them basically saying to landlords, let's basically make sure that the property that you're letting out is energy efficient, basically. So E at the moment and C on new tenancies from December 25, and from 28 all tenancies, even existing tenancies, must have EPC rating of C or above. I do believe that EPC certificates are required annually if you're letting out. I think, again, correct me if I'm wrong, but letting rules are not my forte. I focus on the tax elements. So are the costs allowable? Surprisingly, it's depending on the expense, is whether it is or isn't allowable. HMRC basically view the expenditure in the same rules as the previous slides. If it is a new addition to the property or a significant improvement, then it would go under capital expenditure and not be allowable against income. And if it is minor maintenance or repairing pre-existing, let's say insulation, for example, or draft proofing, then that would be an allowable expense against income. It's basically taking a view of the expense and what is currently or previously was there prior to the addition / change of said insulation. So why did it keep quite a rigid stance on this? Well, basically from 2006, I believe, through to 2015, there was a landlord energy saving allowance, which basically allowed for landlords. It got released periodically, I think, from I think it was 2006 through to 2008. certain things fell within this allowance. And per year, a landlord could spend £1,500 and have it allowable against rental income, provided that they had obviously improved the property for energy efficiency. So I believe it was like insulation 1 year, draft proofing the next year, flooring insulation the next year, wall cavities the next year, and that was basically what got introduced year on year. And there was a £1,500 allowance per year for landlords to then basically improve the efficiency, energy efficiency of their properties. If you didn't take that up, then basically you've missed out on an allowable expense there if you didn't previously have it. And that's why HMRC keep quite a rigid stance on not allowing things that previously weren't there. So basically, in a nutshell, if your client is adding something new to the property, such as additional insulation, draft proof, and new water systems, so there's all solar powered water heating systems now, etc. All this would not be allowable as revenue expenditure because it is all new to the property. If they have a solar water heating system already installed and that breaks or they need to replace it, then that would be allowable in this instance. So again, it surprisingly depends, considering if you don't meet these requirements, then you wouldn't be able to let. However, that is not a HMRC view on this, and they will stick with the whole capital versus revenue. Was it there previously? Is it an improvement ruling on this? So with that in mind, let's just, if you can do that, Leanne, just skip back to the poll and see if you can stick it back up and see if people can change.
Won't let me do it again.
Will it not? Nah.
No, and I tried re-adding it as a new one while you were talking, but because it's a duplicate, yeah, it won't work, unfortunately.
Never mind. Well,
apologies.
So in that instance, then everybody in the Q&A then stick in there now what they think in regards to is this allowable? Yes, no, depends, or unsure. Following the information on the previous slide. I'll move on as people are typing and entering. If people are typing and entering, just trying to be a little bit more interactive. Yeah, if people can go from that would be great. So based off what we've spoken about today, capital expenditure, revenue expenditure, what is allowable, what isn't allowable, EPC ratings, what are the rules, or what are the rules that I've managed to find online, and whether that is allowable. We will move into a third and final poll before Q&A. So please indicate how helpful you found our webinar today. We've got a 5-star rating system. Again, Leanne, if you can just flick that on. That'd be great. If we can try and get the same amount of percentage, 60% plus, that would be great. We're moving up slowly. That's good. That's good. And again, if anyone has got any questions, then be sure to stick them in now. Also, if you don't think it's been helpful today, or you think that there could have been certain topics that you wanted to know more information about, then please let us know in the comments or the question and answers. I can see that it's gone fairly static in terms of voting, floating around the 60% of people voting. So I will publish now. Perfect. So we've got 50% of people who are currently present have voted, and we've got 79% thinking it's 5-star in terms of being helpful, 17% 4-star, and 2% 3-star. So again, if you have voted 3 or 4-star, if you just stick in the Q&A or comments how or what you wanted to know in order for it to be more helpful. We can either touch on that if I know it now in the Q&A section / tax chat section, or if not, then we can keep that in mind for future webinars. as you say there's room for improvement, so we'd rather improve than constantly give you 3-star webinars, in your opinion. So thanks for everyone that's voted, by the way, and I appreciate the average rating of a 4.8. Thank you. So hiding those results and coming to the next page, we've got the Q&A. I can see there's 17 comments, whether that's just people saying yes, no, unsure. I'm not too sure, but Leanne, if you can enlighten me on what's been asked, and we can get to answering it.
Of course. So yeah, just before we start the Q&A section, just to let you know that we did have quite a few people join us, possibly like 20 minutes in or something. Presentation has been recorded and a copy will be sent to all who registered, just so you know. So that should be with you in a couple of hours, so you can watch it back. We do have a couple of questions. The first one is, I have a client who is a childminder. They've built a separate extension for this. Can I claim for parts? Can I claim for this part for the expenses of the business?
It would completely depend on the purpose of the outbuilding that's been built. I would not be able to answer specifically right now on whether it would or would be able to be claimed. It would depend on what it was built for, how it was built, where it was built, etc., etc. So there's more to it than just a simple yes or no. There may be a claim for that, as it's a child minding business. There may be capital allowances involved for that, but then at the same time, if you're claiming capital allowances on that building that's been built, then it would effectively be under the business, and therefore when you come to sell the property, there would be an element that would be taxable, because it wouldn't fall within PPR because it's basically covered by business instead. So capital allowances may be allowable, but it would be best just to double check. And also the consequences of claiming it may result in the client, when selling the property, to have X amount due under chargeable to capital gains tax. Sorry.
Okay, thank you. Somebody did comment that they thought the 2025 deadline is not legislation yet, it's being debated. I had a quick look while you were talking. I have put a link in there for, I know a landlord that runs a decent website, Landlord Zone. He's pretty up to date with the legislation, so I have put a link in there to a blog on that just to clear anything up there. Because it does look like it's still in debate, but there is a big push that it is going to happen. So the landlords might as well just go ahead and get their EPC rating up.
Yeah, I to be quite honest, I did think that, because December just seemed like a strange date, but there was multiple websites mentioning the December, so I just thought I'd stick it in there. And like I said during the presentation, it's, as far as I'm aware, from what other people have been saying, that might be coming in. So yeah.
Okay, and then we've got can capital allowances be claimed on these ECP improvements that are not allowable revenue expenditure?
No. So if it's a normal residential property, then usually capital allowances aren't really claimed. It's very strict rulings on capital allowances for residential properties, if any. Usually it's just car if you are out and about and you have a property business whereby you're spending quite a bit of time. So usually it's no in that instance. Again, case by case basis, but the majority of people would not be able to claim these improvements as an expense against revenue.
Okay, and then we've got, for a landlord using the rent-a-room scheme, would he be allowed to claim for expenses incurred while replacing a damp carpet with a laminate floor for one of the tenants?
Rent-a-room scheme, if you are claiming the allowance of £7,500, then no, it's either the allowance or the actual expenditure. It would be done on a year-by-year basis. If, for example, in this instance, the replacement of the floor was like for like, and it was damaged/repaired, then you could claim it, but then you would lose the the rent a room relief that they may qualify for. So it's one or the other, and usually would look at whatever is the most tax beneficial, i.e. what's the highest deduction against income from the rent.
Okay, thank you. And then that is it with the questions. Just some feedback on the poll that wouldn't work. Practically everybody said depends as their answer there.
Cool.
So we'll say like a 70% of them. The lady that asked the question about the extension, I can see that you've put some more comments on there. If you want to email me, if you just reply to one of the emails that you've had for signing up to the webinar or a reminder, with a bit more information, we could possibly have a look at that for you. But yeah, I think that is it. I don't think there's any more questions. Oh, wait, no, there is. Is income from rent-a-room counted as part of the overall rental income? If also have rental income as well as lodgers income?
Oh, good question. Let's think. So there would be two different sources of income there. You would have the rent-a-room income, which you would be allowed to claim rent-a-room relief against, and then you would also have your rental income aside from the rent-a-room. I would think so. Let me double check on that one though, as I don't want to be giving false information, and I will come back to you on that one. If you can just email Leanne or reply to one of the emails like she just said, and I'll come back to you separately on that one. I don't see why you wouldn't be able to, but I'll just double check.
Okay, I think there's no more coming through. I'm just looking another couple of seconds because I said that before and then another one came through. No, I think we're done now. If anybody has questions afterwards that they think about, then you can always, like I said, reply to one of my emails, and we can see what we can do for you. Okay, so I think we'll draw to a close. Thank you again to the thank you again to the IAB for allowing us here to present this to you today. We hope to see you again very soon. We've got a couple more webinars coming up. I know there's a lot of people joining, so we hope to see you all again soon. So thank you for joining us today. Have a wonderful rest of your day and goodbye.
Thanks, everyone.